Will Australia get another rate cut in time for Christmas? We put the question to one of the nation's biggest investors. Hello, I'm Chris Bourke and welcome to the Bloomberg Australia podcast. I'm coming to you from Melbourne, where the city's gearing up for a big horse race on Tuesday, or more importantly, a public holiday. But while we take the day off, up in Sydney, the Reserve Bank will be hard at work announcing its next rate decision. And today we're checking in with an expert for a preview of what might happen with rates next week and beyond. Adam Bowe is Head of Portfolio Management in Australia for Pimco and joins me today. Adam, welcome to the podcast.
Thank you for having me.
Adam, you're in Sydney, so next Tuesday is just another day in the office for you, I expect.
That's right, just another day.
So we had some pretty ugly third quarter inflation data flashing across the Bloomberg terminal on Wednesday. That closely watched trimmed mean number came in at 1%, even higher than most people expected. Next week's rate decision was always going to depend on this report. What makes these numbers so critical for Tuesday, Adam?
Yeah, you're right, Chris. It came in a lot firmer than expected. Why these numbers are so important each quarter is, we have a central bank, the Reserve Bank of Australia, and their job is to keep inflation within 2 to 3% target band and full employment. So this one came in much step firmer than expected. As you said, 1% on the quarter, but importantly, 3% over the year on trimmed mean, which is right at the top of the 2 to 3% inflation band. After a period of fairly elevated inflation in Australia, quite uncomfortable print for the RBA, I think.
Yeah, so taking all that into account, what do you reckon? What do you reckon Governor Michelle Bourke and her board are going to do on Tuesday?
Look, I think that the inflation print has ruled out another cut for the time being. I think Michelle recently described their expectations as even a 0.9 would be a material miss. So a 1% on the quarter, is quite a miss for them. Importantly, I think, trying to step back from the meeting by meeting decisions from the RBA, more important for investors, I think, has the destination changed? What are they going to do over the next 12 months rather than meeting by meeting? And on that front, I think it's more of a delay to the next cut than a hold, sort of extended pause, or there are no more cuts to come. So we still think, on that front, the current policy rate at 3.6 is tight, and we have growth that's below trend, the unemployment rate that's edging up. So the RBA will take a little bit of time to gather the evidence to get comfortable to cut. So
markets, they'd already started to trim their expectations of a Melbourne rate cut after Bullock's recent comments just on Tuesday night, where she spoke about the challenge of this sticky inflation that's hanging around even as the jobless rate creeps higher. Look, how tricky is this balancing act between jobs and inflation for the RBA right now?
I think it's really tricky for them at the moment because they're telling us two different stories. We have a labour market that's gradually softening. The unemployment rate is slowly ticking up. But we've just had a period of 1 quarter of inflation data that suggests it's firming. So the two parts of their objectives telling different stories makes it very challenging for them at the moment. I think ultimately what that means is they just keep policy on hold until evidence builds in one way or the other. As I said, I think 360 is tight, restrictive policy. So I think keeping it elevated or keeping it on hold at a restrictive level for a little bit longer just means that growth and inflation will be a little softer than we'd expected as we kind of peer into next year as a result. And ultimately, the evidence will build for them to get comfortable in lowering rates next year.
So what do you reckon? Do you reckon we're going to get a rate cut by Christmas?
Not by Christmas. We have 2 meetings left. We've got November and December. I think after that inflation report, they're going to need more evidence than we'll get by December. We will get another employment report. We'll get a monthly inflation report, but I think they're going to need a little bit more evidence. So I think realistically, the first opportunity that they'll get to ease policy rates will be early next year, probably February at the earliest.
So, look, Adam, you of course help oversee billions of dollars in bond investments at Pimco in Australia. Bond markets are often seen as a window into where investors think interest rates are headed, both in the short and long term. What are they telling us? What are those markets telling us right now about Australia's economy and the potential for more rate cuts? Especially following that kind of hotter than expected data this week.
So not too dissimilar to what I described. Probably a little bit more. A little less in terms of rate cuts than what I'm expecting. Market at the moment, sort of following that really elevated third quarter inflation print, has the RBA on hold for the rest of the year, and then one more cut by May. So a little bit less than what we would expect. We would expect the policy rate through next year to get closer to 3%, so 2 cuts at least. But market finishing this afternoon with on hold until next year and just one more cut.
So no mortgage relief for homeowners this year, at least.
That's what the market's saying. We think, definitely not this year. As I said, we think a little bit more than the market, but market suggesting no relief for another 6 months. We think a little bit more.
And when we come back, we break down the world of bonds and how everyday investors can get into them. So, Adam, we don't often dive into the world of bonds on this podcast, probably because it's traditionally seen as an area for big institutions rather than everyday investors. Look, is that starting to change here in Australia?
It is a little bit. I think for a couple of reasons. We've had a material rise in interest rates that investors, even outside of institutions, should see as a much more compelling environment to be investing in bonds, and it's becoming a little bit more accessible. It's been one of the challenges in Australia, just the accessibility outside institutional investors. We unlike equities, they're not exchange traded instruments. So it's been a little bit more challenging to buy for individual investors to buy bonds or invest in bonds. And a lot of the time, minimum parcel sizes have been elevated. So for a corporate bond, for example, minimum trade parcels can be as high as $500,000. So it makes it out of reach for a lot of individual investors. So the easiest way historically has been through mutual funds, through investment firms, and that's still a very attractive option. But more recently, a lot of mutual funds are listing their funds on exchanges. So instead of being able to buy the bonds on the exchange, you can buy the mutual funds on the exchange in ETF format. So accessibility is certainly improved outside institutional investors in the last few years.
And what kind of bonds are proving popular, more popular with retail investors these days?
A broad range of bonds. Generally, what's being listed on exchanges is high quality liquid bonds. So usually portfolios comprised of government bonds, corporate bonds, mortgage-backed securities. So high quality liquid bonds lend themselves to exchange traded format because at the end of the day, exchange traded funds have to be liquid. Investors buy and sell units on the exchange every day. So high quality liquid bond portfolios are typically avenues of interest at the moment.
What does that mean if you're an everyday investor who's curious about getting into bonds? How much money do they need to get started?
Very little. If you've got a brokerage account, you can buy and sell just as you can buy very small units of equities. Now you can buy and sell very small units of exchange traded bond funds. So, I think parcel size is probably a little different depending on which one you're looking at, but not too different to the equity space now, which I think is very compelling.
So why are more retail investors looking at getting into bonds right now?
Well, I think the starting point, Chris, is attractive yields or starting yields. We had a material rise in interest rates, and so starting yields are pretty strong predictors of average returns over 5 years in bonds, and that's a good place to start. The starting yields are also providing reliable income and allowing investors to lock in that income. It's kind of the flip side of the opportunity we had during COVID when we all had the ability to lock our interest rates at low levels on our mortgages. We have the opportunity to lock higher interest rates now in on our assets. And then the final reason investors are looking at the asset class is just the diversification benefits. You expect bonds to do well when the risky parts of your portfolios aren't. And it didn't work during 2022 because inflation was so high. But in periods historically when inflation is low and close to central bank targets, bonds can provide that diversity. So, a few compelling reasons why I think the asset class is garnering more interest lately.
So look, we're recording this on Wednesday, and there's another big event for you, I guess, overnight with the Federal Reserve due to hand down. Well, everyone is expecting, most people are expecting a rate cut. Look, you're constantly talking to some of the biggest global investors, I take it. What's the mood among them about the US economy right now?
So part of a big international investment firm, we're heavily invested in the US. So certainly as we look over the next 6 to 12 months in the US, we think we're going to go through a period of weaker growth. Where there was a big growth was very solid in the first half of this year in the US. Some of that was just a pull forward of activity and anticipation of tariffs, which will roll off towards the end of this year. So certainly expecting further rate cuts from the Fed as we crest into next year. And their growth should stabilize and start to improve through 2026. So a series of rate cuts from here until the middle of next year, and then we see a gradually improving growth outlook for the US.
Does it still look like a good place? Obviously, most of us are invested quite heavily in the US indirectly through our super funds. And I guess, there's been a lot of talk this year, especially from all the uncertainty, the tariffs, etc. And there's been a lot of concern about whether the US is still seen as a long-term solid investment, or a reliable investment, I guess. What's your take on that?
Look, it's a good question. There has been a lot of talk about that. We've looked at the data extensively. A lot of talk about the US losing its exceptionalism, a lot of talk about a de-dollarization of the world. To be honest, when we look at the data, we're seeing very little evidence of global investors selling US assets, very little evidence of global investors selling US dollars. While there's a lot of talk in the media about that, I think on average, when we look at the available data, there's very little evidence to suggest any of that's happening. So certainly from our perspective, being bond investors, we look at a 4% yield on a US Treasury, a 10-year Treasury is looking pretty reasonable at the moment. So certainly, at least in terms of fixed income, attractive place to invest.
If you found today's conversation insightful, be sure to follow the Bloomberg Australia podcast wherever you listen, and check more reading on Australia's economy and bond market on Bloomberg.com. This episode was recorded on the traditional lands of the Wurundjeri and Gadigal peoples. It was produced by Paul Allen and edited by Ainsley Chandler. I'm Chris Bourke.